So yeah, this is kind of like a client question, which came from last week's Q&A or chat session with clients. As there was a client who asked about Toromont Industries. We're familiar with the company, and they also brought up another company which I will highlight a little bit in here, Finning International, just to compare it a touch. So Toromont Industries Ltd, TIH on the TSX, currently trading at about $122.80, about a $10.1 billion market cap, and a dividend yield of 1.56%. So they provide specialized capital equipment in Canada, the United States, and internationally, and it operates in two segments. The first is its equipment group, and the second is its CIMCO or SIMCO, which I'm going to call it. And the equipment group segment engages in the sale, rental, and service of mobile equipment for Caterpillar and other manufacturers. And the Simco segment is involved in the design, engineering, fabrication, installation, and after sales support of refrigeration systems in industrial and recreational markets. And at the last quarter, over 90% of revenue came from the equipment group segment. So that is primarily where most of the business is. Now, the stock has performed quite well, long term, driven by its strong financial results. With the stock up about 122% since March of 2018, and over this time, the company has increased its annual dividend payment from about 92 cents per share in 2018 to about $1.92 in 2024. And like I was saying previously, impressively, the company is really a dividend aristocrat, having grown its dividend consistently for the past 35 years. Now, let's look at the financial results which have been driving the share price and dividend increases. So, first, looking longer term here, we can see that revenue has had a positive trajectory since 2014 and has grown over the last 9 years with a compound annual growth rate of 12%. And most impressively, net income has grown with a compound annual growth rate of about 16.7% over the same period. Now, looking more granularly at the most recent quarter for Q2 of 2024, ended June 30th of 2024, revenue was up about 16% to 1.36 billion and was driven by strength in both operating segments. Net income was 135 million or $1.65 per share, which is actually down about 3% from a gain of 139 million or $1.69 per share in Q2 of 2023. And backlog was 1.3 billion as at June 30th of 2024, which was similar to that reported last year, but was up slightly from 1.2 billion as at December 31st of 2023. Now, keep in mind, the day that we are recording this is November 4th. And after market today, the company will be actually releasing its Q3 2024 results. So once you're actually watching this video on YouTube, newer results will have already been published. So keep that in mind. And I also wanted to just highlight that there is seasonality in the business, which is something to keep an eye on. And just understand if you're looking to invest in this business. As in the equipment segment, they post their weakest quarter in Q1 due to winter shutdowns, while Q4 tends to be the strongest quarter as it coincides with the timing of customer capital investment decisions. And looking at the trailing valuation, the stock trades at about 19.7 times trailing earnings, which, if we compare to its comparable, like I was saying, Finning International, which trades at about 11.8 times earnings, it is more expensive. But if we look at the balance sheet, we can quickly pop up or pick up on at least one reason why it is demanding a higher valuation multiple in the market. And just a quick side note as well, if we look over the past 5 years, the median price to earnings, trailing price to earnings multiple for Toromont is about 21 times earnings. So, it's just slightly below its median right here. But looking at that balance sheet here, um, So this is both Toromont on the left and Finning's balance sheet on the right. First, we can see that Toromont has a net cash position of about 126 million. Meanwhile, Finning's balance sheet is in a net debt position of about 2.6 billion, and has a net debt to EBITDA multiple of about 2.3 times. So again, seeing the much superior balance sheet of Toromont, the elevated valuation multiple begins to make a bit more sense, and it'll even make a little bit more sense if we look at the growth as well, as Toromont has grown a lot faster. Now, just a couple of operational updates here. On September 19th, the company announced its normal course issuer bid to buy up to 8.2 million common shares. So it's going to continue to buy back shares, which is good to see. And on September 9th, the company announced the acquisition of Tri-City Equipment Rentals, which gives the company more of a footprint in southwestern Ontario. But there was limited information on the purchase price, with the company only indicating the purchase price for the transaction was paid in cash using available funds and is subject to customary post-closing adjustments, and it's not expected to have an overall material impact on Toromont's combined revenue, earnings, or balance sheet. So that's all of the information that they really provided. So to conclude here, Toromont is a solid dividend aristocrat, having grown its dividend for 35 years consecutively, and only pays about a payout ratio of about 29%. Now, the company has a solid cash-rich balance sheet and robust backlog. And compared to peers like Finning International, investors must pay up, at 20 times earnings for Toromont. But seeing the better balance sheet and history of growth, I certainly see why the stock trades at a premium. And if someone was looking to hold Toromont in their portfolio long term, I would have a hard time arguing against it. I do think that long term, this is a business that does offer value. The stock may be closer to fair value near term, just because, again, it is trading at a premium to the market. But again, for a long term holding, I think that it's a quality business.
Yeah, and it may be one of those companies, or it is one of the companies that we have on our radar screen right now. And if there is a market pullback, a market correction, it might be a name that we would look at holding or adding, sorry, for the
Yeah,
long term.
exactly.
Yeah, and there's a number of those right now that we see having good value, but are we wanting to buy them at current price? Maybe not, but we may find a time when we would like to buy them. And there's companies sometimes we want monitor 5 to 10 years before we find a good entry point in these businesses. But we're certainly looking at that business. It's a solid business, and it's grown both its dividend revenues, cash flow over the long term. That's what you like to see, and it's not a surprise that it's have a good share price appreciation over the long term.